Good morning, good afternoon, depending on where you are. Welcome to to Getting Started with Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined out there in the chat by my good friend Kevin Horner. Kevin is a going on 30-ish years veteran of the financial markets, and here at Schwab, Kevin is a great resource in the area of trading futures, trading technical analysis, a variety of different topics. He's also one of our co-presenters in our technical analysis and options strategies live workshop series. So appreciate Kevin being out there to help answer your questions. He's there to keep those conversations going and answering those questions along the way. For those of you that are here with us live, welcome to all of you. Chat your questions in along the way. For those of you that are here in the recorded version, be sure to leave us a comment in the comment section, and we will get to those comments as quickly as we can. So the focus of today's discussion, remember this is titled Getting Started with Trading Options, or Getting Started with Options. As such, this is a 12-part series. We started last week with session 1, which is Introduction to Options. Today's focus in this webcast is on trading long call options. Next week's focus will be trading long put options, and so on. And you'll see, and I'll go through the list here in just a minute. And along the way, there are some one-off sessions. I'll show you those recorded versions that are the one-offs in this discussion of getting started with options. But this curriculum today and last week and going forward for the next 12 or now 10 weeks will be focused on going through that cycle of the steps 1 through 12 in discussing getting started with trading options. It is very, very similar to the content that we teach in the live workshop on day 2 in talking about options. So for those of you that are coming from the live workshop or are planning on attending a live workshop, this is a phenomenal companion webcast to that content in day 2 of our technical analysis and option strategies workshop. So we are glad to have you with us. A couple of quick housekeeping items that we need to take care of as we jump into this discussion today. Remember that everything we talk about is simply for illustrative and educational purposes only. It is not a recommendation of any particular security or strategy or account type. Remember that options carry a high level of risk. They are not suitable for all investors. Make sure that you're aware of the characteristics and risk of standardized options before considering any option strategy. Now, a couple of points that I want to refer to since this is a getting started class. One of those is the idea that when we're trading long options, investors may lose 100% of the funds invested, but that is not the extent of the risk in an options trade if that trade is taken all the way through till expiration. There is the possibility that a trader could end up with a long or a short position in the underlying stock, and that could carry with it extended position risk. So we'll talk about that as we get into this discussion. If you are short an option, and we will get into short option positions later in the series, not today. But if you are short an option, there is the potential that you could have the shares called away from you, or you could be put long shares of the stock. And so from that context, there is risk. Anytime you are short an American style option, regardless of whether you're in the money, at the money, or out of the money, closer to expiration or further away from expiration, there is a potential to be assigned early. Now that potential changes. It's not a static probability of that happening. There are times when that probability is higher or lower depending on where you are in that relationship. Now we're going to be using the Thinkorswim desktop software platform. It is not a guarantee of future success out there in the real world, but it is a great learning environment. It is a great sandbox in which to practice and play. But just know this, that there are some differences between how a live trading account works and how a paper money account works. Namely, in the area of order fills. Generally, the paper money account will fill at the midpoint. That may not always happen in a live trading account, first of all. And second of all, the paper money account does not facilitate the early assignment of short options. So that's something to be aware of. We're going to use technical analysis in this discussion today. It's not the only way to look at the market. There are many others. It is theoretical in nature, and past performance no guarantee of future results. So let's kind of roll through the next of these slides. I just wanted to show you where we are. Last week we talked about introduction options. This week we're focusing on long calls. The week following, that's going to be long puts, then covered calls, then buy right covered calls, short puts, short verticals, and on through the series. But we are on lesson number 2, long calls, in that discussion. So let's talk a little bit about what that means, and let's kind of walk through this this process. What does it mean to buy a call? Well, we talked last week about the idea of buying an option gives the option buyer rights to do something. And so the very specific rights that we have when we are the buyer of a call is that we have the right, but not the obligation, to buy the underlying stock at the strike price sometime between now and the expiration date of that option contract. And remember that one option contract represents 100 shares of stock in a standard options contract. There are some different types of option contracts that may be smaller or that may be different compositions, but we're going to generally stay away from those. So let's talk about what it is that we're looking for in buying a long call. Buying a long call is generally a bullish, speculative position, but individually by itself. Now, buying a long call as a component of an option spread, something that we will talk about in later sessions, still is bullish, but it may be done for different reasons. It may be done to define risk in a trade. It may be done to provide offset to the short obligation. So there's a number of different reasons why a trader might buy a long call. So generally, when buying a long call, we're bullish. We expect that the price of the underlying stock is going to move up. And we want to do that generally quickly and to a fairly large degree, right? So we want the price of the stock to move in our bullish direction. We want it to move fast, and we want it to move big. And if it can do that, and it can get out ahead of the passage of time, well, I'll tell you what, that is one of the circumstances that is relatively seductive for options traders, because there's no upward cap on the price of a stock moving higher. So the dream, if you will, is that the price of the stock could move to infinity in a short period of time, and we would make infinite money on the trade. Now, infinity doesn't oftentimes come in upward price movement, so we've got to temper perhaps our expectations a little bit. But here's the thing to think about. There is the possibility of losing all of what we put into the trade if the price of the stock goes against us, if it doesn't move at all, and time passes. So those are some of the potential risks in buying a call option. So we think about this, right? We've got that unlimited upside potential, and we're doing that with some leverage. We could buy the shares of stock, and then we're going to pay whatever the cost of the price of the stock is. But we could buy a call option that gives us the right to buy the stock. It doesn't give us dividends. It doesn't give us shareholder rights when we buy an option, but it has an expiration date, but it's going to cost less theoretically, right? So typically, long call option traders are looking for short to intermediate term upward movement in the price of the underlying stock, and they want that to happen pretty quickly. Now, where does max theoretical loss come? If that long call option is held through expiration and it is not in the money or doesn't have any intrinsic value, then that option contract is going to be worthless, essentially. And whatever we paid for it is going to be gone, right? So we've got to face the music that time decay is not our friend when we are the buyer of a long call. We do not want time decay to pass, but we can't hold back or turn back time. And so we know that it's always going to be working against us. Now, we also have to think about this. In buying a call option, in order for us to start profiting on that trade, we've got to overcome the price of the underlying stock, has to overcome that break-even component. Because remember, we're buying a long call option. When we say long, it's not talking about the time frame. We're talking about being the buyer of that contract or the seller of that contract to begin with. So when we are long an option contract, we are buying that contract to begin with. And when we buy it, we're paying for it. We got to overcome the cost of what we're paying for. So that break-even component is going to be something that we've got to pay attention to. We've got to look at doing the math to see if that makes sense. So we start to think about what this looks like. Now, just really quickly before we get in here to this discussion, we jump over to the platform. Let's think about some of the things that we might pay attention to in looking for stocks that we maybe want to trade a long call option on. One, generally stocks that are already in an uptrend or beginning to be in an uptrend. But we generally want stocks that are already moving in the direction that we want the price to go. And it's much like buying a stock. We want to think about buying stocks that are already in an uptrend, that are continuing to move and may continue to move. Now, stocks with higher trading volumes, meaning very liquid underlying stocks. Looking to trade where the people are, not to try to find diamonds in the rough that might move, because we've got to deal with slippage, bid-ask spreads that we've got to pay attention to. So trading where the people are is an important consideration. Tight bid-ask spreads are a manifestation of that idea of trading where the people are. Now, maybe stocks that are uptrending stocks that are breaking above a resistance level, bouncing up off of a level of support, or giving us one of those hold close above the high of the low day types of scenarios. So that's kind of the characteristics of the price of the stock. Now, think about this. If we're looking at buying a long call and benefiting from the underlying stock price movement, we're generally maybe not going to convert that right that a long call option gives us into ownership of the underlying stock. So Journey asks a great question. Why call it a long call when you want it to move quickly? Because long, in that sense, does not refer to time frame. Long refers to being the buyer of the option contract to begin with. Short, in this case, would refer to being the seller of the option contract to begin with. So long does not imply time frame. If we were to say long dated, then that would be referring to the duration of the option contract. But just being long a call means that we are the buyer of that call option. Good question to ask and good clarification there. So some considerations when buying calls. We have to be bullish. We want to look at buying an option that has some intrinsic value generally. And we have to balance the time in which we're giving the stock to make the move versus the cost of the trade. So let's do this. Let's pop out to the Thinkorswim platform and let's take a look at a couple of examples here in this particular case. Right? So let's go to the chart, and I've got an example. Let's take a look at this one. TG. Actually, you know what? I'm going to do this one. FDX, FedEx. So here's a stock that is in an uptrend. Right? The 50-period moving average is moving in an upward direction. The stock has bounced up off of a level of support. We've got a little bit of a pullback and maybe a little bit of an upward move. Now breaking back up above that 50-period moving average. But our general expectation here is bullish. We're expecting the price of the stock to continue to move higher. We're past the earnings announcement. It's generally been moving higher. Now, one other thing I wanted to note real quick, and Kevin's done a great job of pinning this out there, is we've got a feedback survey in the webcast. It's out there in the chat. If you're here in the chat with us, do me a favor, fill that out. Help us to make these sessions better for you. Click on that feedback link. You can set it aside if you want to and then come back and fill it out later. But just so that you don't miss filling out that feedback survey, that's going to help us to make these webcasts better for you. So I've got a bullish expectation. And I don't know necessarily when the trend of this stock is going to stop. So I'm going to look at trading this bullishly in a trend trade. Now, one of the things that I wanted to pay attention to here is the indicator that I've got down here on the bottom of the screen is the implied volatility measurement. That is the kind of level of supply and demand for options on this particular stock. And those are both calls and puts that are feeling that supply and demand pressure. So one of the things to think about when buying call options, and we'll talk about this too when we talk about next week, buying put options, is we generally want to think about buying low and selling high. We want to buy when that implied volatility is low and selling when that implied volatility is high. So we want implied volatility to be in a relatively lower position and with the possibility of moving higher. That benefits us as the buyer of a long call option. So let's kind of put a trade together here. Our expectation again for FedEx is bullish. So what I'm going to do is I'm going to come over here to the trade tab. And in the trade tab, I'm going to look at a couple of things here that I want to pay attention to. One is how liquid is this underlying stock? And so right now, with the market being a couple of hours old, this is currently trading at about 672,000 shares. This typically trades well over 1.5 million shares average daily trading volume. The other thing I'm going to look at is I'm going to look at the width of the bid-ask spread on the underlying stock. And it's relatively tight. It's about 30 cents bid-ask spread. Now, as the market gets moving, I mean, this isn't the most liquid stock, but it is generally a fairly liquid stock. And I've got fairly narrow bid-ask spreads. One of the reasons why we want to have a liquid underlying stock is that it means generally better pricing for the options. Going out and finding a diamond in the rough that doesn't trade with a lot of liquidity on the underlying stock generally means that the width of the bid-ask spreads on the options is likely to be wide as well. So something to pay attention to. So here's what we're going to do. We're going to go out and we'll just put this trade together and we'll kind of talk through the circumstances of why. I'm actually going to go out in this particular case to about 65 days to go until expiration. That's out to the 18 June. Now, could you go shorter? Yes. Could you go longer? Yes. I'm going to go out to about the 18th of June. That's 65 days to go until expiration. Now, JV Texan asks a great question. What's the rule of thumb on what the bid-ask spread width to avoid? And I don't have a really solid answer to that. Only from the standpoint is that it depends, right? Bigger stocks that have higher prices are generally going to have wider bid-ask spreads sometimes. More volatile stocks are generally going to have wider bid-ask spreads. I just want a narrow bid-ask spread. If I see that bid-ask spread in the dollars wide instead of the pennies wide, then I'm going to be perhaps a little bit more wary of that bid-ask spread. So something to pay attention to. The fact that we're here at 25 cents wide on the underlying stock, I'm just fine with that. There's no absolute rule to that. So what I'm going to do is I'm going to go out to the 18 June expiration, because remember, our option chain is going to show us the expiration and the number of days to go until expiration. And I'm going to open that one up. So now that I start to look at these strike prices here, I'm actually going to take this down a few numbers because I don't need 50 strikes, 25 up and 25 down. I can adjust how many I'm displaying. But remember, we're looking at the call side. So what I'm going to do is I'm going to turn my filter on, much like we've done before, and I'm just going to filter to the call side since we're just talking about long calls. So my option chain is now just displaying call options. And remember, I've got my bid-ask spread here, and I've got the strike price the expiration date, and I'm displaying right now delta, gamma, theta, and vega are 4 option Greeks that we need to pay attention to. So let's talk about how we might put a trade together here. So I've got this one right here. And again, this is not the most liquid, so I might go looking for another expiration here, because that's 24.30 by 25.70. That's a little over $1 in bid-ask spread width. So that's a little bit illiquid for what I want to do with this trade. So I'm going to come back and I'm going to look at the next one in. So I'm going to look at the 29 May. And those are even wider. And I'm going to go out to the 17 July. And those are a little bit wider as well here. So maybe we come even in a little bit more. I'm going to come down to the 22 May. And those are, wow, we just don't have a lot of liquidity in some of those options. This is one of the challenges. Let's come back into the 15 May. That's a little bit better. So that's 31 days to go until expiration. So what that means is going a little bit shorter, our time decay component is going to be an important consideration, because the closer we are to expiration, the higher that sensitivity of this option is going to be to the passage of time. How did I get that delta, gamma, theta, vega? I've got the layout that I can choose that'll show those columns, and I can specify what I want to put in that layout. I can choose from a predetermined layout. There's a number of them: Theo, price, and mark, volume and open interest, position intrinsic and extrinsic, whatever I want to display here in those columns. So I've got this set to delta, gamma, theta, and vega. So delta and gamma are directional sensitivities. Theta is time sensitivity, and vega is volatility sensitivity. How sensitive is this option to the change in implied volatility? So one of the things we talked a little bit about last time is the idea of intrinsic value. Intrinsic value is simply the mathematical difference between price of the underlying stock and the strike price of our option contract. I want to have an option contract that has a little bit of intrinsic value, because I know that at expiration, that option contract is going to resolve to, if I were to hold the contract all the way through till expiration, that contract is going to resolve to either 0 or intrinsic value. So I'd rather buy an option contract that already at the outset has a little bit of intrinsic value. So if the price of the stock does nothing and I were to, for some reason, hold on to it all the way till expiration, I still have a little bit of intrinsic value to fall back on here. So I'm going to go to an option contract that's just slightly in the money. The 370 strike gives me about $1 of intrinsic value. Now notice that's not a terribly wide bid-ask spread. It's gotten a little bit wider here. So I'm going to look at buying that 370 strike. That 370 strike, let me just highlight it, has 55 cents of delta sensitivity, which means that for every $1 that the underlying stock moves, the option premium is going to change by about 55 cents. So if the stock moves $1 up, our premium is going to add 55 cents. And if the price of the stock moves down $1, our premium is going to lose about 55 cents. The deeper in the money we go, the higher the delta. The lower, or the further out of the money we go, the lower the delta. Now, the other thing that we can think about that delta is as a proxy or an approximation of probability of that strike price being in the money. Now, it is not the only proximate view of that probability. It is one way of expressing it. There's also probability ITM, probability OTM, which may be more precise calculations. But this is kind of a thumbnail view of the likelihood that this 370 strike is going to be in the money at expiration, which is ideally, when I'm buying a long call, what I want to have happen. That price be in the money at expiration. Now, my gamma sensitivity tells me how much delta is going to change for each dollar movement of the underlying stock. Now, 30 days out, gamma is not a big issue, but we go closer to expiration, and at the 370 strike, gamma becomes a little bit bigger issue. Not huge in this case, but not insignificant. Now, theta becomes the component that we're working against, because when we are long an option or when we've bought an option, doesn't matter if we're a call or a put, anytime we are long an option, anytime we've purchased an option to begin with, time is working against us. Time is working against us, right? So that's one of those components. Now, Wacky asks a great question. Let's say the stock is really moving and the sector is really moving and the market's really moving in a particular direction. Do I always trade with intrinsic value? And the answer to that is most of the time. And I'm not going to say it's always or never, because here's the thing. The circumstance and your opinion about what you think the stock is going to do will dictate. Now, the trade-off, and there's always a trade-off with trading options. If I were to buy a further out-of-the-money option, lower probability of success, right? If success is determined as being in the money at expiration, buying an option that has a lower delta out of the money has a lower probability of success, but it's going to cost less to enter. So if it does get to that point where it's in the money at expiration, that's going to be a higher percentage gain on a percentage basis of what we paid for the option. But it's less likely to happen. So you decide what kind of trader you are. Are you a more probable but more cost, less efficiency or less leverage kind of trader? Do you want that higher probability? Or are you a, hey, I'm going to swing for the fences. I'm not going to make as many hits, but it's going to cost me less. And when I do make a hit, it's going to be a bigger bang for the buck. If that's the kind of trader you are, then you may consider buying an out-of-the-money option. So you got to keep that in mind, right? The thing about it, and I think Kevin's made a good point here, is a lot of new speculative traders gravitate towards out-of-the-money options, thinking, wow, whoo, I don't have to pay very much for it, and if I get a win, it's going to be a big one, and it could be, but it's not likely to happen. So you get lucky when it does. And then to that point, as you do this for a while, maybe you start migrating to those at-the-money or in-the-money options and thinking, I don't have to be right as often because I've got a higher probability of success here, and I'm paying a little bit more, but I've got some intrinsic value if the price of the stock just does nothing and goes sideways. So let's create this trade here. That theta sensitivity is 22 cents for every day that goes by, eating away from that option premium. And that's going to accelerate as we get closer to expiration. So that's something that we're eventually fighting against. So we've got about double the directional sensitivity that we have time sensitivity here. Now, that vega component, much more significant further out in time, much less significant as we get closer to expiration. That means that if implied volatility were low when we bought the option and it goes up, that's going to benefit us as the buyer of an option contract. If we were the seller of an option, we generally want to think about selling high implied volatility and letting that implied volatility fall. But since we are the buyer of the option here to begin the transaction, we're looking for low and rising implied volatility and a relatively high vega number, especially if we were buying an option fairly far out in time, is going to be part of that. We've got to recognize that if implied volatility changes quickly, and we're still at the early stages of the option contract, that's going to have a pretty big impact on our option premium. We could see the price of the stock moving in the direction that we wanted it to go, the stock being directional, our option being directional, but still losing money on the trade because implied volatility is collapsing and falling. So something to pay attention to as you put this trade together. So we're going to go ahead and we're going to fire this order off. I'm just going to left click on that ask price. And we're going to walk through this trade. So this is one contract of the 15 May expiration 370 call, and I'm going to pay roughly 14 bucks for it. Now I click on confirm and send, and that means I've got infinite maximum gain, but I've got a potential loss of what I'm paying for the option contract in this particular case. Now, since I'm paying $14 for this contract, that means in order for me to start really making money on this trade, I've got to overcome what I paid for the contract in order for this to start making money. So that level is going to be the strike price plus what I'm paying for the option. That puts my break-even price at 384. So the price of the stock's got to move at least that far in order for me to start making money on this trade. Again, something to pay attention to if you're buying out of the money options, where that break-even price is. But generally, your break-even might be a little lower simply because the option premium or the strike price is further out of the money or out of the money, and that premium is going to be a little bit less. You're going to pay less for the option, lower break-even point, but at the same time, lower probability of the price of the stock getting to that level. So we're going to go ahead and we're going to fire this order off. We're going to put it in our long options group. And I'm going to go ahead and click on send and fire that order off. And we ended up buying it. We got it at the midpoint, 1375, which is fine. That's good. Now we're long that option. So I'm going to come over here to the monitor tab. I'm going to show you that's where it is right here. That's that FedEx option. 31 days to go until expiration. We bought it for $13.75. We want this price to go up. How that price goes up is the price of the underlying stock goes up, or implied volatility goes up, or both. Okay? Yeah, so doesn't the contract gain value if the price of the stock moves a penny up? Yeah. If the price of the underlying stock moves up a penny, sure, that option premium is going to increase. But remember, we got to overcome that cost of the trade. We got a sunk cost here, Pablo. So we got to see the price of that stock continue to move. So we could turn around. And again, we've got to overcome also the slippage in the trades. Let me show you a couple of examples. I've got an example here. This is a trade that I bought a while back. It's got 3 days to go until expiration. It is in the money. This is the GE Vernova 17 April 840 call. I bought the call option for $86.15. It is now $165.25. So it's done what I expected it to do. But now I've held on to that to very, very close to expiration. So I've lost most of the extrinsic or time value that I could have benefited from. There's not a lot of reason to hang on to this particular trade longer than this from that standpoint, unless I absolutely wanted to convert my right to buy stock into shares of stock. But I don't necessarily want to do that. I don't want to hold 100 shares of GE Vernova in this particular account. So I'm going to look at selling this call option back. Let's take a look at the chart here real quick for GE Vernova. GEV. And you can see that GEVs continue to go up. I've got that 860 call. That gives me the right to buy the stock here, and it's currently trading on the market here. So I could use that as a means to acquire stock, and I could just right-click and exercise and fulfill that exercise there, which would mean that I would end up with a long position of GE Vernova stock, but I'm giving up any remaining extrinsic value in that option if I were doing that. So you know what I'm going to do? I'm going to simply sell this, all right? So I'm going to right-click, and I'm going to look at creating a closing order to sell this option contract. Now I could roll it. If I wanted to continue that direction, I'm going to just sell this call option and bring in that premium. So I'm going to click on confirm and send, read through this order, make sure that this is what I want to do. I'm closing this trade down. So I'm trading the option contract, and I'm going to go ahead and click on send, and that order filled, and I got it for $160 or for $165. So that's one that went in my favor. I do also have one here that I think went against me, and that's this one. This is Akamai. So here's a call option that I bought for $8 per share, and it is currently trading for 40 cents. So the stock has gone exactly the opposite direction that I wanted it to go. Bought it at the 116 strike price, and the stock's currently trading in 89. So this is an out of the money option. And now it's quite out of the money. Let's take a look at the chart. AKAM. You can see what's happened here. I let this go through that time frame, and even though I got an upward movement in implied volatility, the price of the stock just crashed. So that took away the value in this option contract. It's now trading at 40 cents. I paid $8 for it. All right? So I'm going to go ahead and I'm going to look at closing this trade down. Here's where that one is. You can see, as a matter of fact, I've got to add a few strike prices here to see where that one is. I'm going to add 40 strikes, and we'll see if we can find where that strike price is that we are long. Wow, I have to add even more. We are really, really out of the money here in this particular case. So I'm going to look at closing that one down if I can, if that's a possibility. So let's see if we can sell this back for 40 cents. I might not be able to sell this. Let's see if we can bump that up just a little bit and try to close this out. So that's one of the dangers of buying an out of the money option, is the price of the stock goes against us. So a couple of questions along the way. Do we use technicals to see how long it usually takes FedEx to move? Yeah, absolutely. That might help us to determine how much time we use to create the trade, how much we go out in time, how long we go out in time to buy that option. That's a consideration. Do we need to check and see if there's open interest when you sell GV, or is it needed only when you buy? It's probably a good idea to pay attention to that, but at the same time, what's going to be probably a better indication of that open interest is going to be the width of the bid-ask spread. And the thing about the sell orders is we can just have that, we can have that sitting there trying to work, and we might get filled. So Barb asks a great question. Why close it versus just let it expire? Well, I can still salvage potentially 40 cents out of that trade, number one. And number two, what happens if the stock makes a big move? Right? Well, there's the possibility that, I could end up in a situation, let's say it pops up close to expiration. If I'm just saying I'm going to let it go and expire worthless, there's the possibility that I could end up with a long stock position if it moves into the in-the-money position, and then it moves back down, and now I could have position risk. So you got to think about that in terms of the trade. So the thing about it is, I'm a big fan, and I think many traders are fans of the idea of closing trades down positively prior to expiration, rather than just letting the trade go through to expiration. So why sacrifice in that particular case, Barb, or Barbara, that additional 40 cents, right? How that additional 40 cents, why let that additional 40 cents go? Let's see if we can sell it and recapture some of that premium. So again, one of the reasons why we think about buying options that have intrinsic value when we buy those. So now, as we take a look at this, so let's come back over here. I've got a couple of other examples I wanted to look at real quick. Let's take a look at this one. Let's take a look at NVIDIA. And NVIDIA moving sideways, kind of moving out of that scenario here, breaking out above a resistance level. And we've got the implied volatility at a fairly low position and kind of staying stable here. But we've got a pretty good upward bounce and the possibility of this breaking out of that resistance level. So let's go ahead. Let's take a look at the trade tab here for NVIDIA. And let's see if we can put together a trade here. So NVIDIA, again, already traded 83 million shares today. Quite a bit tighter bid-ask spread on the underlying stock. And let's see if we can put together a trade that is maybe a little bit longer in time. So I'm going to go out again to that 18 June timeframe, and we'll see what our bid-ask spreads look like near the at-the-money strike. And so those are quite a bit tighter. That's, I think, a much more liquid scenario than FedEx. So what I'm going to do, again, is I'm going to look at buying an option that's in the at or just in the money position, having some directional sensitivity, so a delta of above 0.50 or above 50 cents. So they've got more directional sensitivity than not, and a little bit greater probability than not of being in the money at expiration. So if I were to come in and I were to look at, say, for instance, the 193 or 192 strike, I might even go a little bit deeper in the money in this case, but I've got lots of granularity to choose from here. I'm going to go to the 193 strike. It gives me a 15-cent wide bid-ask spread, so 57 cents of delta, so a lot of directional sensitivity here, not a lot of gamma, 11 cents of theta, which means that time decay is working against me, and a 32-cent vega. So I want to play the what-if game here really quick before we go. I'm going to change this layout to Theo, Price, and Mark. And the 2 points that I want you to look at and pay attention to are these. So let's reset this number real quick. Okay, we're going to reset that. So here's what oops, I want to do my filter to calls once again. All right, Theo, Price, and Mark. So the two numbers that we're paying attention to on the 193 strike, 1423 and 1423, just about 1423. So now what I'm going to do is I'm going to change the expectations here. I'm going to move the stock price up. Let's make it $10. So that's going to put us out at about 204. So now we ask the question, well, what is that option worth if the price of the underlying stock goes up $10? Well, now our option premium has gained about $5, almost $5. Delta, remember, is about 57 cents, and our premium has gone from 1422 to 2051. That's assuming no time decay. We know that $10 move's probably not going to happen in one day. So I'm actually going to go out a couple of weeks. I'm going to go out to the 28th of April. So now we've made a $10 move to the upside, but we've had 2 weeks of time decay. So my $14.22 premium that I just paid for this option now moves to $18.98. A little bit of time decay ate away at some of that gain. Now, what if implied volatility, which was low, continues to rise? What if we see, say, for instance, a 10% rise in implied volatility? What does that do to our option premium? So our option premium, we paid $14.22. That option is now trading at $21.70. So a rise in implied volatility benefits us as the buyer of an option, a long call. A rise in the underlying stock benefits us as the buyer of a long call. The passage of time hurts us as the buyer of a long call. All I'm using is the Theo, Price, and Mark comparison tool so that I can play that what if game. I can say, hey, what if the price of the stock goes up? What if time passes? And what if implied volatility goes up? So let's go the other direction, and let's filter this to calls once again. And let's play the what if direction. Let's say, well, what if the price of the stock goes down $10? You see, we lost almost half of our premium. What if time passes out to 2 weeks? Now we did lose about half of our premium. And what if implied volatility falls by 10%? Wow, we lost about $10 of our option premium. If the price of the stock went down, the time passed, which isn't inevitable, but implied volatility went down. So this is a trade that is directionally sensitive, time sensitive, and volatility sensitive. You've got to pay attention to those components of the trade as you trade long calls. So let's do this. I'm going to pop back over here really quickly to the slides, and we're just going to talk about these. Okay, so we want the price of the stock to move. We have to pay attention to earnings that might change implied volatility, and we've got to fight against the passage of time. We've got to figure out how big an impact that time has on our trade. So I want to do this. I want to show you some additional resources. I'm going to pop over here to the Trader Talks webcast page on YouTube, youtube.com/@TraderTalksWebcasts. When you get here, click on that subscribe button if you haven't done so already, and then type in long options. Now, my good friend Rachel Deschelle is going to be up next, so you guys can stay right here. She's going to be teaching long options, another great webcast focusing specifically on trading long options. She's probably going to trade long calls and long puts, but That's going to be a great follow-up to what we've done today with trading long calls. Now, next week, we're going to be talking about trading long puts. Remember to give us a quick subscribe there, follow us on social media, and my thanks to Kevin Horner for helping me out and our great production staff and our great reviewers as well, and thanks to all of you for being here. We'll see you guys again very soon. Take care, everybody. Bye-bye.